Hi guys, and welcome to Freckle Finance. Today I'm going to do a video on the differences between an open and a closed loan. So generally when you're applying for a loan, there is an option between an open and a closed loan. That does not mean the place that you're applying for the loan has the option, but generally all types of loans or any type of financing you will get, some places will have open loans and some places will have closed loans. So which loan type is the best one to choose? A closed loan is a fixed payment amount that you have for a certain term of the loan, which is agreed upon at the time that you're signing for the loan. But generally, there are penalties to making payments on that loan. So if you're paying $325 a month for that loan for 48 months, that is what you're going to pay. If you do want to pay off early or pay extra, there is almost always penalties. With an open loan, you will have the same structure of you will have a payment and you will have a certain term. However, there is no penalties to paying more or paying off early with that type of loan. Or at least within Canada, it is actually illegal to charge any fees on an open loan for paying more or paying off earlier. So you're probably wondering, if you don't have penalties on an open loan and you have penalties on a closed loan, why would you ever get a closed loan? Well, generally, closed loans actually have lower interest rates. And that's because if you're thinking about from the finance company's perspective, they are guaranteed to get that or close to that amount of money every month, so they can actually lower their interest rates. But with an open loan where you have the options to pay off quicker, they actually lose more money if you pay off quicker because there is no penalty. So they generally charge a higher interest rate for open loans. I also just want to point out that with the open loan, it means that every extra dollar that you put onto the loan goes directly to the principal of the loan. You will not be paying interest on the extra payments. However, there are obviously interest calculated within your regular monthly or biweekly, whatever payment structure you have set up. So paying off the open loan earlier will directly affect the amount of interest that you pay, and you will save money on your interest. Companies have different ways of handling how this works out. Some companies will reduce the length of time that you end up to pay off the loan, and some of them will readjust and reduce the payment. If you're in the situation where you have a lot of debts and you're trying to pay them off and some of your debts are closed and some of your debts are open loan, I mean, it does depend on the interest rate, but it's probably better for you to pay off the open loans first because you won't be getting the penalties on those loans. I also wanted to point out that this is not discussing credit cards, which are usually considered revolving loans, but this is installment loans where you do have a fixed monthly payment every month. Now, I never encourage anyone to finance. However, people are not going to listen to me and they're going to finance anyways, and some people are in the position that they have no choice. So I want to make sure you are educated on which type of loan is better to take out. So it may seem like an open loan is the better option because you can pay it off more quickly. However, if you are in a situation where you really don't actually in the foreseeable future see that you're going to have the ability to pay off any extra from the payment that you're going to get, it may be best to take the closed loan because at least your interest rates will be lower. However, it's not always the case. You may actually get an open loan with the interest rate lower, and by all means, if that's what you get, take it. However, if in the near future your financial situation is going to change, or maybe you're going to get a lump sum of money in the future, it is definitely best to take out an open loan. You can at any point pay it off. You could have gotten that loan last month and pay the full thing off with no penalty. So let's say you just need a little carryover finance money, so you can take out that loan and pay it all off. So you would definitely in that situation absolutely not want to get a closed loan, because the closed loan, you will likely be paying them most of the interest that you had originally agreed upon to pay, but the open loan, you do not pay interest for months that you have not been financed for. Basically, take into consideration your circumstances. What the best type of loan for you may not be the best type of loan for someone else. But definitely don't blindly guess which one is the best for you. Do your research, think about your life situation, and really thoroughly assess which is the best one for you. I will link below a loan calculator from the Calculator Soup website that will help you assess which one is the best. So if you have several options and you know what the interest rate and the terms of the loan is going to be, you can put those numbers into this calculator and it's actually going to say how much interest rate you're going to pay. As well, if you click on the amortization calculator, which I believe you have to click on that in order to find out the total interest, it'll actually say how much you're paying every month. So if you're on the open loan and you decide you're going to pay it off in a year instead of, let's say, the 4-year loan that you have, you can actually see how much interest you will be paying on that loan if you make all the payments regularly, the amount that you owe, and then lump sum pay it off at that point. As well, whether it's an open or a closed loan, the interest rate that you actually pay per month reduces as the loan decreases in price, the principal reduces. So the calculator, the amortization calculator portion will also show you that. So if you're close to the end of your fixed loan, you may not actually be paying that much interest on the loan anyways, and it might not be worth it, especially to take the penalty. I just want to state quickly that I have been using the term fixed loan. However, this counts as a variable loan too. That just depends on how the interest is calculated and whether the interest rate changes or not. But I just mean fixed loan as in you generally have about that payment every single month. This also is not exactly how it works with mortgages. Mortgages is kind of a special type of loan. It has a lot of its own special rules. There's semi-open, closed, you can pay off on fully closed a certain amount. So mortgages is a completely different thing. So this is for non-mortgage type of installment loans. So I hope you have a bit more understanding of the difference between what an open loan and a closed loan is. If you do have any further questions, as this is definitely a more complicated subject, please ask below and I will either answer the question, or if I feel that it could use a whole new video, I will answer it in a separate video. So don't be scared to ask questions. And as usual, if you find these videos informative and interesting, if you want to know more about finances, click subscribe, as I'll be uploading videos regularly. Have a good day. Bye.